We're now going to look into chapter 22, which follows up behind chapter 21. In chapter 21, we learn how to develop what is commonly referred to as the master budget. You're also going to hear me relate information to it, and I'm going to call it a static budget. The use of budgets is very important in controlling a company's operations. And the use of budgets doing that is known as budgetary control. Such control takes place by means of budget reports, and these reports compare our actual results for a period with what we had originally planned out. The budget reports provide management with feedback on operations. And we're going to see how to do this in chapter 22. We are going to take our original master static budget that we put together in chapter 21, and we are going to flex it. In other words, we are going to take and look at our actual activity for a period, and we are going to use that quantity of the units produced and flex the original master static budget to be more representative so that we can compare our actual results to what we had calculated as cost per unit and our overall fixed costs when we did our original planning. So we are going to perform budgetary control by taking our information and turning it into budget reports, and we can use these reports to compare the actual results of a time period with what we had originally planned. Okay, so our planned objectives were stated by way of management and the management accountants and the individuals at the company who worked collectively to put that master budget together. You guys are going to see that on these reports, it is going to give management stated numerical information that provides feedback on the operations. Of note, these types of reports that you're going to see that we can do in this chapter can be prepared as frequently as needed, daily if necessary, many times though weekly or monthly or quarterly or even annually. Management will be able to do an analysis. We can take the information that you guys are going to learn here in this chapter 22, and I assure you we can take it much, much further. The accounting students are going to have a class after this Principles of Accounting 2 course. They will be taking a class called Cost Accounting. They will also have as an option to also take a course called Managerial Accounting or Advanced Managerial Accounting. I highly recommend that you do that if you are interested in working in industry. There'll be a lot of information discussed in regards to why are there differences between the actual results and the planned results. For anyone that's planning on being a manager in industry, especially in the areas of some type of manufacturing or production environment, I'm going to highly recommend that if you're not an accounting student and you're planning on that career route, you should at least take a look at the textbooks and possibly even buy one from the bookstore or from another student, and you will find that it will come in handy to you later on your career path. We learned in chapter 21 that we go through many, many steps starting out with our sales budget and ending up with a budgeted income statement in our operating budgets area. And then we also developed some financial budgets, including a budgeted cash sources and uses, our cash budget, and we also had a budgeted balance sheet. We will then, of course, use that as our plan of action, and we will proceed on during the period and have actual results. How many units did we manufacture? What did we literally have to pay out for our direct labor and our direct materials and all the other items? And we're going to track those costs, and we are going to plot them out and call them our actual results. And then what we want to do is compare them to our original plan, the master static budget, if you will. We're going to learn how we flex the numbers in this chapter, and so that we can get a clearer picture of the differences between actual and budget. Management, once they're able to analyze, they can then discuss ways of going forward and doing a better job, so taking corrective action. And when the next set of budgets are put together, management will be using modified information, considering what has happened in the past. Budgetary control works best whenever a company has a formalized reporting system. These reports are going to be generated, and on them they need to have the name of the report. It also needs to show how frequently the report is generated. It should also state specific purposes for why the report is generated. And then it should also indicate who all has received a copy of the report. Again, this budget information is internal information, and it is not necessarily shared with everyone within the company, depending on the type of report. So we need to have people getting what they need in order to do their job, but we do also have to keep it on a need-to-know basis. Here are some examples of some budget reports that can be disseminated and how often, many times, they are put out, as well as why they are put out, and who typically receives a copy. If you would, instead of me rattling these off to you guys, pause the video here for a moment and read through this PowerPoint slide. So you guys know that I'm still cutting and pasting review questions and practice problems and do-it reviews at the very, very end of every PowerPoint file that I load for you on Blackboard. So my advice is that you guys go and pull these up after you've watched the lecture video and run through some of those practice problems, the do-its, and the review questions to make sure you've got the information before you proceed to doing your homework. So budgetary control involves all but one of the following. Using static budgets is the one that does not fit in. Recall that I mentioned our master static budgets are developed, and they are based on a specific quantity of units that management expects that we will sell. And we start there and come up with all of those numbers. Well, when we do budgetary control, we are going to be comparing actual results to what we had budgeted. But in order to compare apples to apples, we have got to flex the master static budget we can still use the same cost per unit for items. For example, what we had expected in our variable cost types of items and how much is our total in fixed cost. But we are going to use the actual quantity of units times those predetermined amounts and then compare those flexed amounts to our actual results for a period. And then we will be able to determine the differences between the actual and planned results, and we can modify our future plans going forward. So static budget, what we developed back in chapter 21, is a projection of budget data at one specific level of activity, number of units, if you will. When it's used in budgetary control, each budget included in the master budget is considered to be static. So again, at one level of activity. So this in essence ignores data for different levels of activity that could be taking place. We want to be able to compare our actual results, right? Well, we're going to have to flex the numbers. So with our static budget, we need to be able to compare our actual results with budget data, but at the activity level used in the master budget. So here we've got an example. Here is the budgeted sales dollars for the first quarter, 180,000, and the budgeted sales for the second quarter, 210,000, for a total budgeted sales of 390,000. However, the actual amount of sales for the first quarter is only 179,000, and for second quarter, 199,500. Therefore, if you compare what they had budgeted to what their actual results are, they were 1,000 under budget. Now, notice, people, that I'm talking about sales or revenues. Okay, 179,000 is not as good as 180,000. Okay, so we're under budget by $1,000 difference. What about second quarter? 199,500 is not as good as 210,000 for a total of 10,500 under budget. So therefore, if you were to take the total, you can see that for these two quarters, we are 11,500 under budget for our first two quarters of 2014 sales. If we wanted to go and take a look at how this would be plotted out on just the sales budget report, notice that it has a $1,000 and a U. Okay, so we're $1,000 unfavorable. So you guys have got to get it straight in chapter 22 that when revenues are not as good as they're supposed to be and they're under, then it's unfavorable. If the actual sales are higher than what was budgeted, then it would be favorable. All right? When we get to cost and expenses, if our cost and expenses actual number is less than what was planned in the original master static budget, then we have been favorable. But what if our actual results are more expensive or cost us more than what we had planned? Then that would be unfavorable. So be very careful when you're selecting favorable or unfavorable as your description in your budget reports. Here we can see the results for the second quarter, 10,500 U for unfavorable, and here is for year to date. Okay, so both quarters budget amounts versus both quarters actual results for a net of 11,000 favorable, 11,500 unfavorable. Now, keep in mind, people, that if you have an unfavorable result in quarter one and a favorable result in quarter two, you would net that positive and negative number together in order to get the year-to-date number. We do have some uses and limitations when we are looking at our budget reports. They are appropriate for helping us to evaluate a manager's effectiveness in controlling cost. You're going to see that we're going to call this controllability, what a manager has the ability to manage. And many of you all are either going to be evaluated in the future using some of the things that you're going to see in this chapter, or you are going to be the accountants helping to gather all this information and generate reports that managers will be evaluated with. So we're going to be looking at our actual level of activity. And if it closely approximates whatever our master budget activity level was, then we can use it. We can compare the cost and what we had planned. We can compare the revenues and what we had planned, especially if our behavior of cost is fixed in response to changes in activity. So we're not expecting any massive differences. It is definitely easily to use our fixed cost numbers, but it is not appropriate for our variable cost. And I'm going to show you that when our units of activity change versus what we had planned, that we basically have to recalculate in order to have a good set of information to use to analyze results. So a static budget is useful in controlling costs whenever our cost behavior is fixed, because we wouldn't expect there to be much of a difference. But whenever we've got cost and it's variable or mixed, we're going to have some issues. So that is where we're going to bring in this idea of flexing our budgets. A static budget does not modify or adjust data regardless of the changes in activity during a year. So as a result, actual results are always compared with the budget data at the activity level used in developing the master budget. But what we're going to do is we're going to flex it for the actual quantity produced or sold, whatever the budget we're looking at happens to be. With a flexible budget, it projects what the budget data needs to show for various levels of activity. So when we're talking about units of activity, how many did we expect to sell versus what we actually sold, we are going to be taking that original master static budget sales price per unit and using the actual quantity. And then we're going to compare the actual quantity and the dollar per unit we expected to sell it for against the actual quantity sold and the actual dollar amount it was sold for. And then we can analyze the differences. So we're going to do this flexing of our budget in order to get more useful information. With our flexible budget, it is essentially a series of our master static budget that we put together in Chapter 21, but it's going to take into consideration different activity levels. It can be prepared for each type of budget that we did put together in Chapter 21 in that master budget. Why would we need to do this? Well, with our numbers being different, our actual performance versus what we had originally planned in the master budget, we want to be able to talk apples to apples. And I'm going to show you that in the next video.